I think that we could structure the panel around sectorial type of trends and issues, and maybe kick off with a light question to start with. Perhaps each of you could maybe give an explanation or a description on how you saw the F&B sector in 2015 and what your outlook is for 2016. And then after we have a look at the outlook, we could look at each of the risks, how those risks affect whether you're a very focused retailer or an integrated processor, and how that might affect investment decisions from the market going forward. So maybe if you want to kick off with take a turn on that outlook question in terms of where we've been this year and what potentially 2016 has in store. So Mou Lih, if you want to kick it off.
Okay. As I just now mentioned, 2006 may not be a difficult year for the retail S&B services, especially the restaurants. Main thing is that because a lot of people are worrying about the rental, the materials, and the labors in the past. As what I shown in the chart, raw material price has been coming down gradually since the beginning of this year and is still on a downtrend. That's why the others supplies of raw material company has been dropping. Whereas for rental, because of the developments in the past, a lot of malls are buildings and coming out, and the competitions. In Singapore, there's this trend that people are crowding to malls. Just now, Eugene mentions security is a KL issue, but Singapore is not the issues about securities. It's just that people like to go to mall. I remember when I was a young analyst, the first mall started at Yishun. Yishun is the first regional mall. A lot of people start wondering, why start a mall in a housing estate instead of in the Orchard area? Whether the crowd will be there or not. But now you can tell that actually regional malls are more crowded than Orchard Road. That is the fact. And lately when the next opened in Serangoon, all the HDB shop all close shop. They are selling cheaper. The price is cheaper. A lot of things are much cheaper at the provisional shop or whatever shop in the housing estate. But people still buy from the mall. That is the trend. That's why I say as the economy develops, people's spending power change. And as the income increases, the amount of money they spend on food and beverage proportion is smaller. So it's not that sensitive. Next year, a few trends is quite clear. Raw material cost is going down. Rental is likely to go down. That's why you hear a lot about REITs. People are worrying about REITs because rental may start going down. But that will be good for the F&B sectors because one segment of their cost is going down. So for 2006, I think it should not be as difficult as in the past few years for the F&B sectors.
Okay, Brandon, do you want to share your views?
So I just got to keep it short. I think I do agree partly with Mou Lih in terms of the cost is coming down. But having said that, for analysts to pick up F&B is not as easy because when we go to the announcements, like I mentioned to you, that we do see a lot of the word challenging keep appearing in the discussion paragraph. So perhaps they want to do the disclaimer. They want to forewarn you first that 2016 we will expect somewhat a slowdown, and that would kind of impact their top line. Having said that, we also saw that some of these restaurant business, they have already diversified regionally, going to China, going to Malaysia. So if the region slows down, the revenue for this company will come down also. Right.
Joon Hong.
Yeah, good afternoon. Let me just clarify. I'm speaking from food and buyers perspective, and we are in the food and beverage segment, but we are slightly different in the sense that core activity means to us like manufacturing and distribution, and of course branding in the countries where we market to. So being in the international market, as what Jasmine shared with you just now, we are into many countries internationally, although we have certain core markets that we have achieved success over the last 20 years. Now, what does 2016 mean to us, and also what has happened in 2015? How does it affect our business? I think the two main trends that we are watching very closely. One is, of course, commodity prices. And commodity prices in the world is now low, as some of our fellow colleagues have mentioned. Low for a couple of reasons. I mean, oil prices itself is down and so on. But for whatever reason, when commodity prices are down, it does mean some cheaper ingredients, cost of ingredients to manufacturing. However, when commodity prices are down, many of us should recognize that all commodities are priced in US dollars. And the trend over the last 1 year or so has been that the US dollar has been strengthening. And if you speak to any bankers today, the US dollar will continue to strengthen. In fact, the anticipation is that it will strengthen even more in the coming year in 2016. So when US dollar strengthen, commodity prices are down, it brings good and bad news. Good news is, okay, the ingredient cost might have come down a bit, but we are dealing in US dollar and we sell to countries around the world which are not buying in US dollar. I'm talking about consumers. For example, you take a consumer in Russia. Now he is buying things in rubles, and when the US dollar goes up, it means that things will become very expensive for him. And that will definitely have an impact on the way that we're going to sell, the pricing that we're going to achieve in those markets, and ultimately the profitability on us as the manufacturer, the distributor, and the marketeer in those countries. So going forward, how it impact our business is that the trend of the currency will have an increasing influence on commodity prices, which in turn has influence on our cost of production. But yet at the same time, the currency will also affect, bring bad news to us in the markets, the international markets whom we are selling into. And it's going to be very challenging. It requires us to even be more vigilant in the way that we procure our raw material. For example, how long term or what kind of time span do we consider when we book raw material? Is it for 3 months, for 6 months? And nobody is nobody will be able to tell the future. And if we can tell the future trend of currency or commodity, I think I shouldn't need to sit down here and still work for a company. So that is the challenge that we face. Having said that, I think the company has grow over the last 20 over years, and we have gone through many cyclical trends in commodity, in currency, and also in market crisis in various parts of the world. So the challenge really for us is to monitor very closely and be very prudent in the way that we're going to do our procurement. And in terms of pricing, we always, being a brand conscious, and branding is one of our assets in competition, we are not the top brand, although we wish we could be, according to Eugene, but we are far away from leaders like Nestle, or Kraft. They are the big boys. We call them the big elephants in our industry. So we always look towards to them, how they do the pricing, and we always price ourselves 5 to 10% lower, so that people will be able to buy good value products, good value for money products, and this has been our strategy. Thank you.
Must qualify as top brand in the markets you operate. I think last year was pretty hard on F&B for manpower because of the government's policy. It was extremely tough. But I think going forward, I think that's stabilized. That has stabilized, and it is actually, I would say, like all the results, it's still challenging, but we are cautiously optimistic. I think one bright spot is that at least rental is more realistic now, I think. However, competition is still very strong, meaning that there's always someone who will rush in and open a store in some of the branded malls. But what I think is interesting is for Singapore, it is pretty stable if you get your brand right. You know, if you get your brand right, our consumers are quite loyal. And however, so what is interesting is going forward is in the region. I think the region gives a lot of opportunity for us to do cross-border acquisitions, because right now the Malaysian ringgit is low. So and therefore Singapore F&B stocks could take the opportunity to do some meaningful M&As and expand their presence. So I think 1.6 should be good for F&B.
Is it from what we've been discussing? Is there a potential relationship in that the smaller retailers of the F&B sector are more type of microeconomic driven through those material costs, labour, rent, etc., where your upstream chain, your wholesalers to your integrated processors to your producers are more macroeconomic driven in that the US dollar currency, global growth in general will have more of a impact on the stocks? Or is there something else we should look out to as investors if we're wanting to do our due diligence and not just look at the restaurants and see the queues in the restaurants, but if we wanted to do a little bit more due diligence to ensure the companies are on top of their risks when they're kind of like midstream, upstream? Is there a potential, should we be looking at a balance sheet? Is there other areas we should look at potentially? If we could come back to you, Eugene, then we'll come down.
Very good question. So in Japan food, we probably the highest gross profit margin F&B stock around. We do 83%. And that's because exactly what you say. We look at our supply chain and we try to manage that risk. So we manufacture our own ramen noodles. We make our own gyoza. So when you can control the supply chain and not depend on supplies from Japan, it kind of allow you a lot more buffer. So for Neo Group, they bought into Dodo, they bought into City Vegetables, and that's supposed to give them supply chain predictability. I think catering, Singaporeans love, I believe, fish balls and vegetable is key. So if you just do F&B retail and you don't put a little bit more thought into your supply chain costs, that will be risky.
Joon Hong, I think you mentioned you have lines into 50 countries, as many as 50 countries, and the US dollar is obviously paramount. When you're looking at assessing the currency risk, is it still predominantly, as you mentioned, US dollar?
Yeah, the US dollar, the strength of the US dollar will always be watched carefully by us because the core markets, our core markets are emerging markets and they continue to be emerging markets. Russia, Eastern Europe are at the moment still our core markets. Although we are trying our best, as you can see in the presentation over the last couple of years, we are shifting to try and diversify more of our markets into Asia. So besides Eastern Europe, now we are into China, Vietnam. Vietnam is a very interesting up and coming market for us, and China as well, and also Myanmar, Myanmar and Malaysia. So that's one way that we are trying to mitigate some of this so-called over-concentration of our market in Eastern Europe. Yeah.
Brandon, may I ask, when in your coverage of the sector, are there any particular red flags or key variables that you look at in terms of making a judgment call on the outlook for the stock?
I think, so like I mentioned that we do a lot of bottom-up analysis, and I think what we dislike or red flags is that what's important is whether they can increase prices, then pass on to clients, and how to mitigate your higher material costs. And actually, I do admire Eugene. And actually, I have mentioned, I have met up with a new group. I met up with Japan Food, and I met up with Bread Talk plus your Jumbo. So companies that we like is that they have ways to move around the pricing of the products they're selling. So case in point is a new group that I visited, Mr. New, like 6 months ago, and because if you receive a pamphlet, which I think I do in HDBs, that they have different pricing from $8 to $12 to 15, and then your orange clove is like $20. So there's different kind of price segment, and within the selection, there's a lot of moving parts. I.e., if you choose $8, you probably get bihun and fried rice and some samosa. But if you choose a higher one, you get your prawns and your. So there's a lot of ways that can play around to maintain your margins. So we do like new group one way or another. Similarly, for like I mentioned, if your jumbo, that they can adjust the price accordingly to seasonal prices. So that kind of business model is something that we prefer, rather than you go in a brand that is not known and you have to fight with a lot of competition selling similar products.
Mou Lih, do you agree in that those type of stocks like Neo Group, which I think delivered 1,000 buffets on Chinese New Year Day, or 2002? 2000. Yeah, buffets on the one day and Chinese New Year. And obviously you've got a defensive factor there. Do you agree that you have that good sort of choice here in terms of a potential defensive play? And in that segment map of the F&B sector you had, where do you see the most, I guess, defensive traits going into next year?
I have no view on Neo Group because I don't receive their brochure. I also don't ask for catering. Okay. As what Eugene said, you are the best judgment of what is you are asking for and what the company is. If you really order their caterings and you continue to order, that shows some things. The variety is okay, the food is well done, and so on and so forth. Especially just now, Eugene mentioned about specializations. Okay, I share an experience. My wife go to hawker center. When he see a store that sell ramen, raw mee, chicken rice, whatsoever, one store sell several products, she straight away skip. And when she see a store that have only one or two types of foods, especially one type of foods, she will try. That is the specialization means. Because when you are not specialized, the quality may drop. And as an analyst in the past 20 over year analyst, when I see a potential companies coming out, then you go and attend a briefing. Then the boss starts saying, oh, I want to expand downstream, I want to expand upstream. Most of the time, I skip the company. Yeah, I think lately you don't see this type of companies around, but I think about 10 years or few, especially during the China stock booming periods, everybody want to go downstream, upstream, whatsoever. And all those companies no longer exist. So this is my experience or my view on the F&B, because you are the best judgment of the whatever you taste, you feel good, you think that you are going back, this is a good company. But doesn't mean that you can buy, because it depends a lot on valuations, the pricing, and whatsoever. Just now Eugene also said he missed the Starbucks. So you just keep in mind, this good company you can keep in mind. Valuation can be high, but don't ignore, because certain things may happen because of economy, because of politics, because of whatsoever reason. Price may drop, and that may be a good opportunity to enter.
Eugene's nodding his head, so we must ask, and if we may, is Sirius Investments looking at any new F&B stocks for the new year in 2016? I think our largest 10 have pretty much declined with the region, which is expected because within those 10 there's only the one stock that's generating all its revenue in Singapore, Sheng Siong Group. I think the broader market's weaker. Our broader market is slightly weaker. Are there any potential F&B clusters or types of stocks that you're looking at going into next year?
Okay, I've been buying Japan food. And one of the shareholders asked me, hey, Eugene, why you buy Japan food? I say, it still gives me 4% yield. Takahashi-san, when there was manpower, labor shortage, he goes to the store and be a waiter. He doesn't spend his wealth lavishly. He still stay in the same place. So I can sleep soundly, right? So I think we pretty much invest in the same companies that we got involved because we are quasi-private equity. So we try not to put our basket. We don't really believe in spreading out too thinly. But I always keep an eye on the US F&B shares. So recently in the US, there was a stock that listed Shake Shack that did very well, but came off. So like maybe timing is always very critical. Timing is always very critical. And the economy doesn't look very good, a lot of volatile incidents. Maybe when the market react negatively, it's a good time to go in. Yeah.
You brought up an interesting point in terms of looking at private equity. And if I could ask Joon Hong, in terms of your competitors, or your I guess companies that are in the similar lines of business, companies that are involved in retailing, the whole wholesaling, production, processing, manufacturing, that might not be entirely have its entire operations listed on the exchange. I'm always surprised. I think we're all kind of surprised that McDonald's, which we all talk about, especially in the F&B sector, has a market cap of around 140 billion Sing dollars versus Singtel, which is 60 billion plus. So McDonald's, which is everywhere, is in market cap only twice the size of Singtel, thereabouts. But how much of McDonald's is actually listed? Is that the McDonald's restaurants that's listed, and the production and the manufacturing and so forth is off the market? And if many integrated processors around the world have operations that are private, is there opportunity for those to come onto the market in the coming years ahead? Yeah.
I mean, honestly, I don't do a lot of deep analysis on McDonald's. I just know that my kids go McDonald's, and therefore, I think there is always opportunity for the upstream, like production of food, to come, more of them. I hope that more of them will come and list on the SGX, because Singapore is slowly. I mean, I think there's slow accumulation of F&B stocks. So I think food production and even food logistics and different parts of the entire chain could find their way to SGX. I think we have a good reputation. Our PEs are not very low. You know, Ajisan, China, and Hong Kong, this market a bit of exchange. PE in Ajisan in Hong Kong is lower than. That doesn't mean it's fairly value or what. I mean, PE in Ajisan is lower than PE of F&B in Singapore. Yes. Right? Why? Because the whole craze over online, offline in China. They don't believe in opening stores will give you growth in China. They like online, right? But in this part of the world, you still like to go to the malls, go to restaurants. So the PE and growth in Southeast Asia seems to be still attractive. So I think exchange is I mean, it's good to have to encourage more food manufacturers.
And many international ones. Joon Hong, could we ask you about that growth that Eugene was discussing? Lots of growth in Southeast Asia. Are there any other parts of the world that you've seen growing significantly that enable a big international business that already has international operations to move into and sell those potato chips and that good instant coffee too, and those great ads?
I think eventually any food retailers, whether restaurants or cafe chains, when they grow to a certain size, I'm speaking based on the experience that we had through our M&A activities. We do talk to companies not just in this region, but in other parts of the world, and we study how they behave and where have they come from in terms of, let's say, a cafe chain. Now, they will eventually grow to a size whereby they have more outlets and their branding becomes an important thing for them as well in their country. And some of them are from, let's say, a reputable country, more established country like Japan or Korea, and they start to bring this branding overseas and start franchising. Now, ultimately, it is also important for this kind of chain, when they have, say, 500, 800, or 1,000 outlets, for them to consider the supply chain issue, because that is very important. Having a good hold of your supply chain can help you in two ways. One, of course, you have better management of your supplies in terms of timing and quality. The second is, of course, in terms of cost control. You know, I mentioned about commodity prices, fluctuation, and so on. Now, eventually, that is going to filter into the food that you're going to produce and sell. So when you move into supply chain and have better management, whether you vertically integrate and put up a plant yourself, for example, to process coffee from coffee bean into coffee powder, rather than buying coffee powder from some other people's plant. Now that means once you produce your own coffee powder from coffee bean, you move one step back or upstream, and you have better control. You control that value add part of the activity chain, and that hopefully help you to manage and mitigate better in terms of coffee bean prices fluctuation. So eventually, when any F&B company grow to a certain size with sufficient number of outlets, I think there is, from what we can see, there's no escape from their interest into the supply chain as well, because that is like their lifeline, you know, providing them the supply that they need to make sure that their outlets are able to consistently, in terms of quality, provide services as well as food to their consumers or to their customers. So I think that is very important.
And we're coming towards the end of the session. I've been sort of watching Eugene's watch over there in the distance. Brandon, would you mind reiterating your calls in terms of your best stock picks for the sector going into next year?
Okay, I think actually for the list of the companies shown on the slides just now, we don't really cover a lot of companies, just basically one, which is Jumbo. That's what we presented today. And I think just want to add something of what they mentioned, is that one of the concerns that I have with F&B counters on SGX is the liquidity. Everybody likes a new group, but they cannot buy. It's just very hard to accumulate. And that is why some of these F&B companies are not in the radar for institutional investors, because there is always a minimum market cap of 100 million or 250 million before a fund can purchase, as well as sufficient liquidity for investors, funds to go in to accumulate a stake that is meaningful and to get out if they want to take profit. So these are some of the concerns when we talk to investors. These are the criteria that they are looking at. So not so much for institutional clients.
So does that make them, those type of stocks, potentially a little bit more cyclical, because they're probably more retail participation driven, and retail participation can be obviously affected by what's happening in the broader benchmarks. And some of those stocks that don't have high turnover can still be good performers, right? Yeah.
So you may be surprised that actually it's not so cyclical because, like, you know, there's not so much of volatility because simply is that you want to buy, you cannot buy. Yeah.
And the okay, so stick to the big ones. Yeah. Yeah. Okay. I think, and that's a good point in terms of F&B. It is 3% of our total market cap, those stocks that are associated with F&B type of activities, which is pretty small. And of course, the main stock for that is, of course, Thai Beverage, which is a part of the Straits Times Index. Again, that's focused on the region as well. Maybe on those potential variables that are affecting the F&B sector, we might have a look, Mou Lih, at in terms of what you see for those stocks with the Singapore businesses, how you see those those economic indicators that affect the industry moving in 2016. I think lately some growth projections have been revised slightly upwards for the region. Do you see this also transcending into those areas that affect the F&B sector?
Instead of the F&B sectors as a whole, I think for the past few years, actually for the past many years, since the Lehman crisis, the outlook has been wrong year by year. If you all remember, every beginnings of year, they do a projection for next year, for this year, or end of the year, project for next year. Most of the time it's wrong. This year, expect last year, every beginning of year, they expect the economy to be better. Eugene also agree. And it's wrong. So it's very difficult for us to going forward. But as what Brandon said, the institution don't look at the F&B because of the size. But all of you are retail. So they don't look maybe a good opportunity for us. Because certain stocks, especially in SGX, if you dig enough, those stocks that is small cap, not covered very well, a lot have very good potentials, or some give very good dividends, some don't give very good dividends, but you look into it, in fact, every year they are earning a lot of money and they just keep in the pocket. Slowly look at all these companies, actually a lot is there. So as a retail investors, as I said, look at the F&B sector, because today is F&B, look at F&B sectors from a retail point of view, taste it. Okay, one thing I share my view on the taste. Taste is not really say good, is a good company. The food that they provide must be able to, for example, using McDonald's as an example. Everybody took McDonald's. The taste is quite flat. A lot of burgers are much better. But the better burger that you eat, can you eat it every day? You can't. Food that are too rich, you cannot eat it every day. But McDonald's, I did saw, maybe for us cannot, but at least every week or regularly you can eat it. So looking at the food and beverage sectors, that companies that provide good food doesn't mean that taste is very good. But if you don't mind to go back every week, don't say every day, every week you don't mind to go back, that is a trend. Have to say a bit about Japan foods. Because most of their foods, people don't mind going back. There's a better ramen store. A few very good ramen store open in Singapore. Some even get a lot of award. I go there once, second time, then third time I don't feel like going back because it's too rich. Yeah. So that is my opinions, contrary to what Brandon said, because I think he's looking from the institution point of view. But as a retail investors, if you are not looking at short-term up and down, If you are looking at short-term up and down, those stocks that institution don't cover, very difficult to have up and downs. But when the value arrive, just go in. I think it's better than our FD or CPF.
Yeah, a little broad question, and anyone else you can answer. So I often find dividends is often short-changing capital gains, and in fact, the big unicorns in the U.S., Starbucks, McDonald's, you talk about PepsiCo, which has got KFC and all. They're about $100 billion plus, and this is only a population of about 250 million people. In Asia, we've got 3 billion people, but we don't have any big unicorns. So as a retail investor, what do you find as promising stocks which can scale really very big, which can really, as what you said just right now about very flat taste, but businesses that can expand, that can really become $100 billion businesses. Which are the places you would ask us to look at? Recommendations, or what's preventing it to happen? What's the insight in preventing it to happen?
I think we were involved in Ajisen China. It went to as high as about 1.5 billion US. So it's a unicorn, technically, right? And it was scaling from 80 stores to now it's about 650 stores. So China presents a very good market up to now, in my personal view, for this to follow the US. Because China is technically homogeneous. Stores opening in, whether it's in Shanghai or Beijing or Chengdu, it's the same model. We can scale very easily. In fact, we had 4 production center. We open store like a few stores a month, right? But in Singapore, I agree that scaling is a little bit different. So and one of the issue is people. You need people. So in the US, you have 250 million and they spend a lot outside, they eat. You need that mass in order to create F&B unicorns. But I believe that there is still hope of finding restaurant chains in China, India. And I said that in Southeast Asia, it can be 1,000 store potential. Okay, Singapore, 100 stores. Like in Japan food, our goal is very simple. 5 brands, each brand 20 stores. 100, right? Malaysia can easily be 100 store market. Thailand, 250 to 300 store. Indonesia, easily 500 store. Philippines, easily 200, 300 stores. So if you can scale properly around Southeast Asia, it could be a unicorn, right? China and India and Japan has many F&B restaurant chains that are doing well. So we are early stage of what I believe happened in the US.
And in terms of investor access, we don't have one here, but you can see the appeal of sectorial-based exchange-traded funds, because an exchange-traded fund, for instance, might be tracking the F&B sector, F&B index, and by definition, that F&B index should always be taking into account the biggest and the most active stocks of the sector at that time. So, as you can see, some stocks will leave the index, some stocks will join the index. So that type of play or that type of ETF product should theoretically be always taking into account what the biggest and the active stocks are at that particular point of time. So that's obviously an appeal of ETFs overseas in the US, for instance. But as I said, at the moment, we don't have a specific sector one for the regional F&B plays at the moment.
I have this question for Mr. Tan, Food Empire. It's interesting to know that you now have manufacturing plants in Malaysia and that you have the geographical diversification. Do you see your core market changing from Russia and Eastern Europe to eventually becoming more China-centric, perhaps, or Eastern, or in Vietnam, in Myanmar, as you have mentioned earlier? Do you see your core market changing over time? I'm saying this because Russia and Eastern Europe seems to be going through difficult times for quite a while now. and I don't know how long it will be.
Yeah, I think when we say Russia, Ukraine going on for the last 2 years, I think it's maybe a couple of years they have gone through difficult times this round, and it's not just economic; it's a bit of geopolitical as well, as we all know. So to answer your question, firstly, I want to share with you what has taken place in the Russian market over the 20 over years that we have been operating there. The market itself actually has matured. You can see how we have uplifted our brand image from the American Eagle to a more contemporary presentation that appeals to the younger people. So over the 20 years, actually, the consumers in Russia itself have matured. And that was one of the reasons why we had that transformation of our brand image, to capture the younger generation of consumers in that market. Second thing that has changed in the market, even like Russia or Ukraine, is that the overall economic growth has impacted on the people's consumption pattern. In the past, most of the sales are actually only in 3-in-1 coffee, which is the lowest, probably one of the lowest grade instant coffee. Coffee, sugar, creamer, and you just tear and you just drink. But you and I know that if you go into the supermarket today, there is this thing called a freeze-dry coffee, which is like Nestle Go. If you are not a coffee drinker, you should at least know Nestle Go Cap. And those kind of instant coffee is still instant coffee, but it's a higher grade instant coffee. The manufacturing process enable the coffee essence and aroma to be preserved better. So you can try that. And Russia on its own, those Eastern European countries over the years have made that change. In other words, from selling 3-in-1 coffee alone in those markets, we have introduced freeze-dry coffee under our brand McCoffee, and that has taken off very well over the last 3 to 4 years. Even today, it is still selling well. When we say that the impact on Russia market at this point in time, we are talking about the main impact being the currency. But in terms of consumption of the consumers there, it's still taking place. People need to eat, people need to drink, and the products that we are selling are not high-end restaurant products. They are products that people, I mean, when we started selling in Russia, people were buying one sachet. You and I tear the sachet, you take half a cup. You take half a cup, I take half a sachet, you take half a sachet, and we make 2 cups and we drink. But of course, over the years, things have changed. They have moved from 3-in-1 to even freeze-dry. So that market itself will continue. We would like, it's a cash cow situation for us, and we want to maintain those brands. Now, the second change that we introduce here is those new markets, like you say, China or Vietnam. Now, those are markets whereby we have neglected to some extent when the company was growing, for a simple reason. I mean, when we were growing, we have to invest every dollar that the company makes. And every dollar where you want to put into a new market or put into your existing market to grow it further, it depends on return. So if the return is higher in the existing market, if we continue to push up the market share, then we will do that. It's much easier than to invest in a new market, because new market investment means a lot of cost as well. So that was the reason why. But now we have come to a point in time whereby the need for diversifying from those markets become more urgent, and that's the reason why over the last 4 to 5 years we have looked at some of the newer markets in Asia. So going forward, we would like to see the market being balanced. We would still like to have core markets, but we would not like to have core market that is maybe more than 50% of our sales. We would like to maybe have 3 or 4 good core markets, each one about 15 to 20%, and then a lot of other new markets. That's how we would like to see our market balance being panned out as we move forward. I don't know whether that answers your question.
I'm going to give it to the lady first. Yeah, Eugene, I would like to ask you, just now you mentioned that you look for a company for strong cash flow. How do you look up for? From the annual report, balance sheet, or is there a formula to compute on it?
Okay, I just look at, I think first is balance sheet. You look at the balance sheet, there is a cash position. So when Japan Food first listed, we had only maybe around 1 over million in cash. Now we have, including after paying off dividend, we have around 14 million in cash, right? So we are also in non-food. We are also in Jason Marine, and it has 18 million in cash. So we kind of quite obsessed with companies with a lot of cash in the balance sheet. Japan Food has no debt. So you look at the balance sheet, you look at the operating cash flow of the cash flow statement. So every year, if it's a positive operating cash flow, it's cash into the balance sheet. Then I look at the liability, meaning that you can have a lot of cash. Some companies have a lot of cash, but they owe money to the banks, they owe money to suppliers, and that you have to pay. So you need to net off that to make sure that you have the cash is real.
We'll just take one last question. He was the first one to raise his hand.
May I ask you about those companies, F&B, they're not doing well, and why they're not doing well? One example is Bread Talk. There's so many stores in the world, but the share is coming down. I went to one investment seminar, I paid for it, said this is a value stock. I follow Warren Buffett, so I bought it at 140. Now it's about 110. Why I think it's not doing well is because what's so great about Bread Talk? Anybody can enter. You can bake bread, put some honey, it says honey bun. So that's why I'm not doing so well. And they say our taste is the same all over the world. We have a taste here in Singapore. In Shanghai, it's the same taste. We brought all the bakers here and trained them here. So it's not doing well. It won't do well because entry is very easy. There's no barriers to entry. Number two is Super Group. It was doing well, $3. Now look, it's split. Now it's about 80 cents, 90 cents. Why it's not doing well? Anybody can make coffee. Anybody can make 3-in-1. See? But the thing is, Food Empire is very smart. He went to Russia, new country. But coffee, there's so much good coffee in Southeast Asia. Now Indonesia, volcanic coffee is very, very good. And and they say Chinese coffee is very good. But Lao coffee is even better. But the best coffee in the world is from Timor-Leste. What else somebody makes a Timor-Leste coffee, the best in the world? Nobody's doing that. Say branding. You're just calling up all the retailers. You're calling up all the coffee shops. Another question I want to ask is, there's one company, F&B, if we debut here, I'll rush and buy it. I miss out on Jumbo. Kopitiam. Everyone knows Kopitiam, isn't it? Kopitiam, I live in Yishun. It's always Kopitiam. That's a very good company. But nobody talks about those companies dying, not doing well, and the ones if we debut, everyone will rush to buy it. Why?
So
It's quite a mouthful of question.
Well, yeah,
the first one was Bread Talk, right?
A really important point. We talk about risks in terms of the material costs, the labour, and the international currencies, but most important risk is market risk. I.e., we buy the share at the price, and price doesn't go up as anticipated; it actually falls, and that's a pertinent point. In terms of the F&B sector as a whole, obviously it's underperformed other sectors such as healthcare in this year. There might be, whether it's come to the end of the economic cycle, whether there's new entrants coming into the market, whether there's going to be some merger and acquisition or some value buying. Could we see more of this in 2016? Could we see things, it's a really bad pun, but spice up a little bit? And yeah.
Okay. Your question is actually a lot of investors have to differentiate two things. One thing is this company good or not? Second thing is this price good or not? A company can be very good, but the share price keep on dropping because it's very high. A good company keep on growing year by year, but the share price is overshoot by maybe 30, 40 times. It has to come down until it reach a certain levels. So if you look at Bread Talk has been growing. The revenue has been growing. Maybe this quarter a bit of surprise, but every year is growing. But the share price is grow above what? is being for the potential, because maybe people have very high hope in the China, the growth and whatsoever. So it caused the mismatch. How come I heard so many people say this company is good, but share price keep on dropping? Because you have to differentiate a good company, and I always mention, enter at the right price. You have to enter at the right price. When the price is too high, it will come down because of expectations. Expectations, I think those who in the market will learn about expectations. 3 months ago, Fed, the chances of Fed increase interest rate is less than 50%. Now it's almost 80%. Right? 3 months can change a lot. So expectation can change. Price can go up and down. So when you invest, keep in mind, a good company can invest, but is the price right or not?
That's a really nice way to end it, I think. A really good point. I mean, whenever we have a report or a talk, there's always the disclaimer is the most important thing, and that's really nicely pointed out. Thank you.
And that was a very, very good way.
The year is coming to an end, and the ASEAN Economic Community is going to be effective 1st January next year. Can we ask the panelists how the companies in the food and beverage industry will be affected by the change? Yeah, thank you.
It's a great question in terms of ASEAN Economic Community coming online. Obviously, some of those integration, cooperation, trade targets have been stretched up to 2020. I think the questions pertaining to, look, we've got 600 million people in ASEAN. On average, an ASEAN consumer spends maybe 60 cents in the dollar versus the average Chinese consumer that might spend 40 cents in the dollar. Is this going to represent opportunities in the next coming years in terms of the modernising population in ASEAN and the increased demand for food and beverage?
Number one. I think if with the AEC, it will be good if the income level from the countries around Singapore increase, because now hopefully more integration of our economies. For F&B companies, we need consumer disposable income to go up. If the consumer disposable income doesn't go up, they can't spend on F&B. One of our challenge, even ramen, like Aji-san, Takashi-san brought ramen here over 20 years ago, and when he first came, he was selling ramen at $7, and one time it was $1.50. So it's very hard for him. He struggled for a long time. But as Singapore disposable income goes up, now our ramen is one of the cheapest in town. We still can sell $7.90 for the entry-level ramen. So hopefully the disposable income goes up. F&B, Singapore F&B brands I personally think stand a very good position, because Southeast Asian economies look to Singapore as a better branded retail concept. Like Indonesia love our F&B concept. They franchise quite a fair bit. So that probably will be impact. As in regulations and all that, F&B expansion is very localized. I don't foresee much difference in F&B concept going to ASEAN, because we are very localized. I mean, we got to look for the local fabricator. We got to the government part can't help too much.
Okay, great. That's the end of it. Can we please give our panelists and speakers a round of applause, please?